Today we're on lesson 3 and we're going to talk about the balance sheet. What is it? What can we learn from it? Why do banks care about it and why should you care about it? But first, we are desperately trying to grow this channel to 1,500 subscribers in 2022. Isn't that cute? If you're watching this and you haven't subscribed yet, can you help an old accountant out? But if you have subscribed, well, please welcome new subscribers every week so they feel like they've just joined the coolest community of small business owners on the internet. Okay, first off, let's understand where the balance sheet fits into the grand scheme of things. Remember, accounting is the language of business, and every year or month, depending on how engaged you are, your accountant produces a set of financial statements for you. Maybe you do it, but I'm guessing if you're watching this, you likely don't do them and you're just too curious as to what these annual reports that you get from your accountant every year are used for. All financial statements have 2 to 3 reports in them, and this is standard and pretty much generally accepted right across the world. And it doesn't matter how big or small the business is. Financial statements all contain at least these 2 reports I'm about to introduce. Firstly, the financial statements all have a balance sheet, or sometimes called a statement of financial position. They all have an income statement, which is sometimes called statement of earnings or a profit and loss statement. And these are the main 2 and most important reports. Some also have like a cash flow statement, which is also known as a statement and changes in financial position. But this is always the case, big or small. Kind of cool, eh? We're just one big family of businesses. Now, the balance sheet or the statement of financial position is going to describe a snapshot of certain account balances on one day of the year, and usually that's at the end of the fiscal year. Think of it like a snapshot picture. An income statement, which we'll talk about on another day, in other words, it tells a story that begins at the beginning of the year and ends at the end of the year. But the balance sheet is like a picture of the state of the business on the last day of the year. If you remember from last lesson, the accounting equation, which is assets equal liabilities plus shareholders' equity, then you already know what kinds of accounts that show up on the balance sheet. Asset accounts, liability accounts, and equity accounts. These are nicknamed balance sheet accounts because these kind of accounts only show up on the balance sheet. You will never see revenue or expenses on a balance sheet. Now, these accounts will be classified as either current, which is also known as short-term assets and liabilities, or long-term or non-current assets and liabilities. And I will explain why this distinction is really important shortly. But first, let's chat about what these distinctions mean. It's really quite simple. When an account has been classified as current or short-term, it just means that that account is either cash or very close to cash, like a T-bill or a GIC, or it will be cash sometime in the next year. And I just mean something like receivables that will be collected within a year or will turn into cash. But I also mean accounts payable to suppliers that will require us to pay out cash sometime in the next year. So in a nutshell, if the account falls under current assets or current liabilities, you will know that the business anticipates that that account will hit the cash either positively or negatively within the next year. So think of cash, accounts receivable, prepaid costs like insurance, inventory, and stuff like that. And so guess what long-term assets and liabilities mean? You guessed it. These are assets that have a useful life which is longer than a year, like capital assets, vehicles and machinery, etc. Or we might have a loan receivable from an employee or another company which will be collectible over a period exceeding 1 year. Same with long-term liabilities. We might have a mortgage payable with a term longer than 1 year. I mean, it's really that simple. So a balance sheet is laid out like this. All the assets are reported on the top half of the report. Current assets and long-term assets are broken out and totaled at the bottom of the top half of the report. The bottom half of the report is for the liabilities, both short-term and long-term. Now, shareholder equity accounts are not broken out between long-term and short-term the way assets and liabilities because these accounts don't really work this way. But the total of the liabilities and the shareholder equity accounts are summed up at the bottom, and here's the cool thing. The assets at the top half will equal the liabilities plus shareholder equity on the bottom half. Again, it's not magic. There is a simple mathematical reason why this has to happen. But we'll talk about this another day. But this is the reason why it's called a balance sheet. Now, If you're ever looking at someone's balance sheet and it doesn't balance, get out of there. Something is very wrong and you shouldn't rely on that balance sheet or anything else they give you in any shape or form. Now, even though a balance sheet only reports balances on the last day of the period, there is a plethora of information that can be derived about a business from the balance sheet. We can learn about how liquid a company is, meaning its ability to pay its bills, how leveraged a company, or better put, how dependent a company is on its borrowed funds. We can get a bit of a sense of a company's value. We can even get a bit of a sense on how profitable it's been over time. And there's ratios, which are standard formulas used to calculate things useful in assessing profitability, liquidity, solvency, and valuation. Not bad for a little piece of paper reporting a balance one day out of the year. This is why the balance sheet is such a big part of the financial statements. In time, I will unpack these ratios for you and show you how to read a balance sheet effectively, and you can assess your business and other businesses. When I do this with you, you'll start to see why breaking down the classification between long-term and short-term assets and liabilities is so important. But for today, I just wanted to introduce you to the balance sheet. Now, for homework, I want you to Google balance sheets for one or two of your favorite public companies. Now, go look at it. It'll look all fancy with lots of fancy sounding accounts, but at the heart of it, it'll pretty much be broken down into the classifications and format I just mentioned. So go check it out. It's really cool. Now, make sure you talk about balance sheets at the next party you attend and watch the circle form around you and prepare for jaws to drop. I'll see you next time. Oh, and by the way, do you want to chat? At my firm, Swain CPA, we are accepting new clients, but only ones that want to become wealthy while expressing their purposes on this earth. So if that sounds like you, go to swaincpa.ca and book a Zoom call with me. Yes, me. It's not like I have 1,500 subscribers or anything, and let's get to know each other. And stay balanced, my friends.